Welcome to HDIN Research. Today, we are performing a forensic autopsy on SIMPPLE Limited, $SPPL. Most analysts see a cleaning robot company. We see a software firm currently trapped in a hardware body. Think of it as a high-tech nervous system, trying to grow out of a heavy mechanical shell. We are dissecting whether SIMPPLE is building the Skynet of property management or just selling overpriced Roombas to airports. This isn't a sales pitch. It's a cold evaluation of a PropTech pivot. Look at this chart. It's the definition of a beautiful lie. Total revenue is up 57%, the kind of number that makes retail investors drool. But look at the red bar. While robotics sales exploded by 188%, high-margin software revenue, the actual brain of the company, shrank by 34%. It's like buying a Ferrari and realizing the engine is being replaced by a bicycle. SIMPPLE is winning the hardware war but losing the SaaS battle in its own backyard. They are essentially trading long-term margins for short-term volume. The endgame here isn't just robots, it's an operating system. They want to be the Windows of buildings. By capturing 50% of Singapore's top-tier FM contractors, they aren't just gaining market share, they are creating an ecosystem hostage situation. When your building's elevators, HVAC, and cleaning robots all communicate through one SIMPPLE brain, switching to a competitor is about as easy as switching from iOS to Android when your entire life is on iCloud. Section 2. The moats. In the McKinsey world, we call this high switching costs. In the real world, it means SIMPPLE has integrated so deeply into Singapore's infrastructure that pulling them out would be like trying to remove the salt from a baked cake. They are no longer selling a product, they are selling a dependency. Let's see how deep these institutional roots actually go. Data point, 52% market penetration. Out of 67 highest-grade contractors in Singapore, 35 are already in the SIMPPLE ecosystem. This includes Changi Airport, essentially the holy grail of facility management. Changi isn't just a client, it's 14% of their total revenue. If Changi sneezes, SIMPPLE catches a cold. But with 6,000 IoT devices deployed, they own the behavioral data of 170 buildings. They don't just own the buildings, they own the habit of the buildings. Meet the brain. SIMPPLE Vision allows a building to not just see a spill, but to automatically dispatch a robot without human permission. It's level 5 autonomy for the built environment. Without this AI sauce, they are just a hardware distributor. With it, they are a software powerhouse that happens to have wheels. It's the difference between a simple tool and an employee that never asks for a raise or takes a coffee break. Let's talk portfolio strategy. Robotics is their star, flashy, 188% growth, but a massive cash incinerator with lower margins. Meanwhile, the software segment is the cash cow on a crash diet. It has a 76% gross margin, but only a quarter of the revenue. The plan is the printer and ink model. Use the $50,000 autonomous robot to open the door, then lock the customer in with a monthly SaaS subscription for life. Now for the cringe part of the balance sheet. Revenue is up 57%, but gross margin took a 10-point haircut, dropping to 49.6%. Why? Because scaling hardware is a brutal low-margin game. Even more alarming, interest expenses surged by 1,345%. That is not a typo. They are scaling fast, but they are paying a speed tax that could threaten their liquidity if that recent capital raise doesn't hit the bank quickly. Look at this red line. Spiking to $390,000 in interest means SIMPPLE was hitting up private lenders for cash at 12% to 36% APR. In corporate finance, that's the equivalent of paying your mortgage with a credit card. It tells us traditional banks weren't exactly lining up to fund the pre-IPO burn. They've survived the crunch, but this level of capital cost is a debt trap they must escape by 2026. The recovery plan. SIMPPLE is moving from survival mode to conquest mode. Section 3 is the roadmap. They are cutting the dead weight and planting flags in Europe and the US. This is the redemption arc of the 2025 story. Let's see if the map matches the ambition. Here is the turnaround timeline. Q1 was about amputation, divesting the loss-making Australian subsidiary to stop the bleeding. Q2 is the refueling stage with a $5 million offering. By Q3, they are invading the EU and US. This isn't just expansion, it's a search for higher margin markets. The goal is to move from a Singapore story to a global SaaS story before the clock strikes midnight on 2026. How do they scale faster? The Pac-Man strategy. They aren't just building, they are buying. They want computer vision firms to make their robots smarter and system integrators to make their sales cycles shorter. They are buying the keys to the doors of global enterprise buildings. It's a shortcut to scale, provided they don't overpay in a high-interest environment. Now for the reality check. SIMPPLE doesn't actually make its robots. 2 OEM partners in China account for 59% of their procurement. In a world of trade frictions, that is a massive concentration risk. They are a Singaporean brain, entirely dependent on a Chinese body and American NVIDIA neurons. It's an efficient setup, but it leaves zero room for diplomatic errors or shipping delays. Let's talk about the elephant in the room, the WIS connection. WIS Holdings is SIMPPLE's biggest customer, its landlord, and its unofficial treasury. They provided interest-free loans just to keep the lights on. While this was a safety net, it raises questions about independence. Is SIMPPLE a truly autonomous entity, or just a tech spin-off of a traditional cleaning conglomerate? Investors hate messy family dinners. SIMPPLE needs to prove it can stand alone. Is SIMPPLE ESG friendly? On the social front, they are a godsend for Singapore's aging workforce. They solve the silver tsunami by replacing aging janitors with silicon servants. However, on the environmental front, they are still in the trust me phase. They claim to help buildings go net zero, but actual carbon data is missing from the reports. Right now, their ESG story is more about human efficiency than planetary salvation. The bottom line, SIMPPLE is at the bottom of the J-curve. They've spent the money, built the footprint, and burned the cash. Now, they must harvest. We are giving them a strategic buy outlook, but keep your eyes on software revenue. If that doesn't start outgrowing hardware by H2 2026, the PropTech dream will become a hardware nightmare. SIMPPLE is a caterpillar in a chrysalis. 2026 is when we see if it actually has wings. That's our deep dive. Now, I want to hear from you. Is SIMPPLE's debt-to-growth ratio a stroke of genius or a desperate sprint? Do you trust a 59% China-concentrated supply chain in 2026? Drop your thoughts in the comments. I respond to the most skeptical ones. If you want the full-page deck, click the link in the description or email us. Let's talk about the future of autonomous buildings.